All right, everybody. So today's topic is one that bothers me to no end as a mortgage loan officer. It's for impound accounts. So when you have a mortgage, the inevitable question you have to answer is whether or not you want an impound account for property tax and homeowners insurance. Most people will know what I mean when I say that. Now, what most people don't realize is all the things we're about to get into in this class, and we're going to try to be methodical without putting you to sleep. But if you watch this for the next 30 minutes, you will leave being way more clear on how impound accounts work, and also most of the time, in my opinion, why you may not actually want an impound account. So we'll get into that. Now, I have joining us today, one of our loan officers, also happens to be my best friend. We've known each other since grade school. We're kind of inseparable. He's my brother from another mother. His name is Jason Thomas. Now, Jason Thomas has been a loan officer for many years, and he's one of those technicians that knows guidelines better than just about anybody. He also spent time in his career in the escrow and title world before loans, back when he was a much younger man. And that gives him a unique perspective. He also had his notary license for a while there. So he knows everything there is to know about impound accounts and how they relate to property tax and homeowners insurance and all the intricacies that frustrate, frankly, most people who end up with an impound account, right? On the surface, an impound account sounds exciting. Oh, set it and forget it. It's one payment. You never have to worry about it ever again. And that's why people opt to take an impound account. What they don't know is that next first year of ownership after they close escrow, they've got quite the difficult challenge ahead of them when it comes to understanding how impound accounts work. Why are they sending you money back, or why are they making your payment much higher than they said it was going to be originally? It can be very frustrating. It can also be scary if you weren't budgeting for these things financially. So I've said a lot. I just needed to get some of the context out there. And Jason Thomas, you're going to join us now. He's been kind enough to get us a presentation that we're going to go through together. So Jay, I'm going to hand it over to you. We're going to go back and forth on this, but let's go ahead and start going through the slideshow together. Sound good?
Sounds good. Thanks, Jay, for having me.
Yeah. So understanding impound accounts. Let's go to the first slide, Jay, and let's start talking about what an impound account is. So, we're just not making any assumptions, and people do understand what an impound account is. If you want to take us through.
Yeah, totally. Let's have a conversation about this. So basically the short answer of an impound account is you have property taxes and homeowners insurance that are a part of your housing expense. And when you have an impound account, these get lumped into your monthly payment. So I think, as Jason previously mentioned, you kind of just set it and forget it. Everything is all included in your quote unquote mortgage payment. And the idea is it's on autopilot after that, and you don't have to worry about these expenses going forward.
At least that's the idea.
That's the idea. Yes, that's the idea if this was a perfect world, and it is far from it, as we're about to find out here. So yeah, I mean, think of it almost like a forced savings account, like we have here down at the bottom of this first slide. Essentially you're prepaying your taxes and insurance so that your loan servicer has money in an impound or an escrow account. And when those bills come due, they get forwarded to the loan servicer and they pay them on your behalf.
Yep.
All right, so let's go to the next slide here. Jay, let's talk about if it's required, because there are instances where borrowers are not going to have a choice on this matter. Two of those loans being government loans, the FHA and VA, regardless, they require you to have an impound account. Certain conventional loans, if you're 10% down as well, they do require this. This is more from a risk standpoint. Generally speaking, you have a lower down payment. Lenders are going to view it as a little more risky. They want to make sure that you're paying your taxes and insurance on time, right?
Correct. Yep. Yeah, and that's an important point that everyone needs to be clear on. Now, my own personal opinion, if you're given the choice to do an impound account or not, I would say 9 out of 10 times my advice is going to be don't do it. Again, we're going to get into why that is later, but I think what Jay is conveying here is that FHA and VA require it, so you don't have a choice, period. You're getting an impound account if you're getting an FHA or VA loan. And then conventional, just to reiterate all this, right? 10% down. If you're putting 10% down or less, you have to do an impound account. The lenders view that as a higher risk profile, and they're going to want to make sure that you make your property tax and homeowners insurance payments on time. And they're going to make sure of that by making sure they do it for you. So that's the reason behind the rules, if that makes sense. So in other words, in not all circumstances do you have the choice. And I think that's an important point for people to understand who's listening.
Yeah, it is an important point. And for those with conventional loans that are lower down payment, you aren't stuck with it forever. At some point, you can request for it to be removed. I actually did that. My wife and I did that for our loan. I couldn't wait to get out of my impound account, and we'll go over some of the reasons why here in a little bit. But if you do have a conventional, you aren't stuck with an impound account per se, but you do have to build up enough equity to remove it.
Yeah, great point, Jay.
Yeah, so on that note, Jay, let's go over some of the pros and cons, because on the surface, obviously, it does sound pretty convenient to have an impound account and not have to worry about making these payments for your tax and insurance on time. So just looking at it, from that standpoint, it is convenient. You do have one monthly payment. It's all collected up front. Your mortgage loan servicer is supposed to be taking care of this for you. Nothing is going to be late as long as you're making your mortgage payment on time. So you've got that convenience factor, and, again, minimizing the risk of missing any payments. Set it and forget it is the idea here. Some of the cons, though, is your payment isn't necessarily going to be set. And we'll get into this in a little bit more detail a little later on in the podcast here. But, taxes and insurance are not going to be set in stone like your fixed rate principal and interest mortgage payment. They can adjust slightly here and there. I mean, insurance premiums go up and down. Tax payments can go up. So your mortgage payment may end up fluctuating as your loan servicer, has to make adjustments for when these bills come in. Another con, potentially, if you want to look at it that way, is you are paying more out of pocket in advance. This can be generally viewed as increasing your closing costs, for lack of a better term, when you purchase your home. You do have to pay up front, and we'll have an example of this later as well. And the other aspect of it is, if you do set it and forget it, you tend to just not really look at what your tax and insurance bills are when they come in, because you don't have to worry about them anymore. So you may get that in the mail, say, I don't have to worry about this, and not realize, hey, why am I paying a lot more for insurance all of a sudden? Or, why is my tax bill going up? These are good things to know, but if you're not actively paying it yourself and your mortgage loan servicer is taking care of it for you, you may not notice these things. And that's where the surprise comes in of, hey, why did my mortgage payment all of a sudden increase?
Yeah, that's been especially true lately, Jay, with homeowners insurance right now. The response to COVID, and at least the state of California, was there were the insurance carriers weren't allowed to issue premium increases year over year for like 3 years, I think. So at some point that's starting to happen, or recently has started to happen. And I think people are starting to get that payment shock factor showing up in the mail because of that. So it's a good point. And I like what you said. Having an impound account kind of means that you're asleep at the wheel and not actually paying attention to that. You only find out when you realize the premiums increased, and therefore your monthly payment on your impound account has increased.
Yeah, I mean, I like to think of it, some of the other bills, if anybody has Spectrum out there and you sign a year up front for really cheap internet and you put it on auto pay, and before you know it, a year's gone by, you're not even thinking about it, and now you're paying $150 a month instead of $100 a month, and you're like, wait, what just happened? Why is more coming out of my account? And it's just like you said, being asleep at the wheel and not realizing that these payments aren't static. They are they can change, and
such
it's
a good analogy. By the way. That's a perfect analogy.
Yeah, that's a whole nother podcast we could do on Spectrum alone. But it is a good point to make. It is important to just stay up on these things so what's going on and what you're paying.
Yeah. Yeah, and usually it's not $50 a month increase. It's usually quite a bit more than that.
Right.
Unfortunately. Cool. All right. Pros and cons. What's next?
All right. Let's go over some property tax basics, and Jay, feel free to chime in as well. I mean, this can get pretty technical, pretty nuanced. So, for California, which is what we're dealing with today, the property taxes, they operate on a fiscal year starting on July 1st, and it runs through June 30th the following year. And homeowners make these payments in two installments. So that first installment, you'll see it becomes due and payable on November 1st, and you got a grace period through December 10th, and after that, it's going to be delinquent. And the second installment, or second half of your annual property tax payment, is going to become due on February 1st, and you've got all the way till April 10th before it's delinquent. And this tax bill, it's based on the assessed value of your property at the time of purchase. So when you purchase your home, the county does an assessment based on the new purchase, and they change the value for the new homeowner of what they're basing property taxes off of. Us as lenders, we generally like to go off of an average of 1.25% annually of the property value to determine what the annual tax bill is going to be. It is going to vary slightly depending on city and county, but it's a good benchmark to go off of, going off of the 1.25%.
Yeah. So a couple things on this slide. The reason we're doing this podcast is because it's complicated. And the amount of times I've tried to explain this in one conversation to a borrower, if I had $1 for every time, I no longer would be working. I'd be retired. The thing is, it's complicated. And what's nice about having this episode memorialized and recorded is even if you listen through this one time and feel completely confused, I want to let you know that that's normal. And I want to let you know the reason we're doing this episode is you can always refer back to it, right? The whole point of this episode is to give you something that you can always refer back to and be like, hey, what did he say about supplementals? What did he say about the fiscal tax bill? And what are the due dates and all that other stuff that confuses homeowners? I've been wanting to make this video for a very long time. We're finally doing it. So don't feel overwhelmed if you're hearing this for the first time and being like, what? Just, record it or rather save it to your desktop and continue to refer back to it, especially if you're a homeowner with an impound account. So I just want to encourage people on that. And then as far as the fiscal year, just to reiterate, people are so confused by that. All it is we're used to a calendar year. That's all we've ever learned at school and everything else. In the business world, a fiscal year is very different. It's not January to December. In the case of the state of California for property tax, as Jay already mentioned and is reflected here in the slide, it's July 1st to June 30th, right? So just want to make abundantly clear, it's not that big of a deal. We're just moving the dates around. It's still a 12-month period. That first 6-month block is July 1st to December 31st. The second 6-month block is January 1st to June 30th. So enough on that slide. There's some due dates and grace periods that Jay talked about. I think it's important that people don't overcomplicate how to establish what your property tax bill is. This 1.25% of the sales price is just a general barometer. That is not 100% accurate. It depends on where in the state of California you're buying. Sometimes it could be less than that, maybe 1.1% more or less. Sometimes it could be much more than that because you're buying in a new HOA community in a brand new development somewhere and there's Melrose and you're paying nearly 2%. So it really does depend on where you're purchasing. These guides we're giving you are just general gauges for you to lean on when you're thinking about trying to figure this out. Okay. Next slide.
Cool. All right, my favorite, supplemental property taxes. If it wasn't already confusing enough, it's about to get a little bit more. So let's dive into this one, Jay. Supplemental taxes. So what is that? I get this question all the time, and frankly, when I first started doing loans, I wasn't even really sure myself and had to learn on the fly because it does get pretty nuanced. But essentially, when you purchase a home, let's say, for $1 million from an owner, and their tax bill is going to be at a much lower tax basis because they've owned the home for maybe 10, 15 years, right? So they're paying a lower tax bill based on when they bought the home. You, as the new homeowner, are going to have what's called a supplemental bill, or something that's in addition to the normal property tax bill, and it's to cover the difference between the current homeowner's tax bill that you're buying from, and then your new tax bill moving forward. We're going to have an example of this in another slide here in just a second. But these are not ongoing tax bills. That's a key point here. Is it is a one-time bill because the assessed value of the property is changing when you purchase from another homeowner who has a lower tax basis. And again, it is prorated as well based on the time of purchase, which adds a little bit to the confusion depending on the time of year. And Jay, one of the biggest reasons that we're doing this podcast, also this last point that I'd like to point out, and we'll get into it a little bit more as well, is these supplemental tax bills, unlike the normal secured property tax bill, they're not forwarded to your loan servicer. And unless you communicate this to your borrower, they are all going to think that this supplemental tax bill is being taken care of by their loan servicer, correct?
Yeah.
And that creates a huge headache to something that's supposed to be convenient for the homeowner, and it essentially turns into a great source of frustration. And we're left picking up the pieces to try to help out our past clients when we inevitably receive that phone call of why is this bill late, or why is my mortgage being changed, or whatnot, right? So
Yeah.
the supplemental bill, it's very important when you receive a supplemental bill in the mail to understand that this is something that you're going to have to take care of.
Yeah. Great points, Jay. So here's what happens. We talked in a slide or two ago about being asleep at the wheel because you have an impound account. Oh, well, set it and forget it, right? And that's the problem. Most loan officers, not trying to be negative, but most loan officers aren't having these conversations with their clients at the time of purchase. They're not talking about supplemental bills. So they're like, do you want an impound account? Yes or no? They're doing the order taking, checking off the list on the box, right? That's it. So that's the problem. And we close escrow, and the old owner, as Jay alluded to, had a much lower property tax bill than you. The county eventually reassesses. It doesn't happen instantaneously, right, at your purchase. Eventually, over the course of the next 3 to 6 months, they reassess based upon your new purchase power or purchase price. They compare the amount of time you've been living in the home up until that reassessment date, and what the old owner was paying, and voila, whatever that difference is your supplemental. Now, that's an overly simplified explanation. There's more nuance to it than that. It depends on when you close and timing, but that's the simple explanation. And again, guess what? Your impound account, I would say, I don't know, it's more than half the time your impound account is not set up to pay these supplemental property tax bills. And because you were not most of the time as a borrower budgeting for that, because your loan officer didn't talk to you about this, well, you might have a $5,000, $6,000, $7,000, $8,000, $10,000 bill you weren't anticipating waiting for you just around the corner. And that's where the pitfall comes. So we can certainly go to the next slide if you want, Jay, if there's an example coming up that we can go over with them.
Yep. Here's an example for you guys. So let's say, today's market, average home around $1 million. Property tax, as we previously mentioned, we're estimating at 1.25% annually of your sales price. So do the math there. You've got a property tax bill annually of $12,500. And the home that you're buying, the owner that you're buying it from, their tax bill, let's say, is assessed at $500,000 because they've been in the home for quite some time. So their tax bill currently is half of what yours is. This is going to create a supplemental bill that's your responsibility as the new homeowner, and it's going to be the difference. And remember, keep in mind, this is simple math. It does get a little bit more complicated than this, but just to illustrate the point, it's going to be the difference between what your new tax bill is and what the previous owner's tax bill is. So if we cut it in half, you're going to have a supplemental bill of $6,250 that is not going to be due right away. It's not going to even be mailed out to you, as Jason mentioned, for potentially, upwards of 6 months, let's call it. That's how long it takes the county to get around to reassessing the property and sending out these bills. And you're going to be required to pay these two bills. Generally, it's in two equal installments. So we've got two to installment payments of $3,125 that are going to be due at some point, within 6 to 12 months of owning this home. And the homeowner, unless they're made aware of this up front, they're going to have no idea that this bill is coming in.
Yeah. Yeah, it can be so painful for people. And the other part about this, Jay, is the servicer, not only are they not willing to, most of the time anyway, pay the supplemental bill for you, as soon as the servicer has been assigned within the first 60 days of the loan closing, they usually do an escrow analysis. And then what happens? Because the left hand doesn't know what the right hand's doing. Not only are our homeowners going to be getting this supplemental bill, but in the first 60 days of ownership, within maybe the first 90 days, they get a letter, right? And it says, hey, here's a check for, right, $3,000, $4,000, $5,000, $6,000, and we're reducing your monthly payment on your impound account because we've just realized that it was set up inaccurately. Your tax bill was, like the old owners reflected, $6,250. It's not $12,500. So congratulations. Here's a big check, and your monthly payment's getting cut in half on your impound account. Have a nice day, right?
And and to that point, Jay, let me ask you this: how many of your past borrowers have picked up the phone and called you saying, "Hey, Jason, guess what? I just got this fat check in the mail. What should I do with it?" From my loan, from your loan servicer, like, "Hey, they just refunded me $6,000. What should I do with it?" How many times has your borrower called you at that point of this scenario, and to ask you for your, professional opinion on what to do with it? I'm gonna guess it's probably zero, correct?
I have never once gotten that call in 20 years. I do get the other call, though. I get the other call,
and that's the next point. The other call, yes, because the homeowner is going to be like, "Hey, I just hit the jackpot. This is great. Let's deposit this check. Hey, honey, let's go on a weekend vacation. Let's do this and that. Let's go spend this money.
Yeah.
Let's pay off this bill, that bill." And then that's when the real issue comes in down the road.
Yeah. Yeah, it's really painful because going back to what we're explaining to you now, eventually, so here, just to try to simplify this, you have to understand that in that first year of you buying a home, there's this transfer of ownership, right? From the old owner to the new owner. And that's where everything gets completely messed up. So the good news is an impound account after the first year of ownership, once all of this is sorted out, is usually pretty painless, with maybe some minor adjustments here and there to homeowners insurance premiums changing or whatever. But if you're not prepared and you get an impound account, you don't know about any of this stuff, it gets really painful because, word to the wise, if in the first 90 days the servicer sends you a surplus check and reduces your monthly payment, do not spend that money. Put it aside and realize they've made a mistake. And unfortunately, servicers do this on every single purchase in the state of California with every single loan that has an impound account. Because again, fast forwarding to this slide, when the supplemental bill does finally come in, because the county did finally catch up with the reassessment, well, that money that they sent you earlier, that's what that money's for. So as long as you hang on to it, you'll be ready. But if you didn't hang on to it and you spent the money and you're already a little financially stretched, now we've got financial hardship. And that's what this podcast episode is trying to convey and trying to help people understand. And this is also why my advice to anybody who has the choice to get an impound account or not, again, sometimes you don't have the choice, but if you have the choice, do not do an impound account. Money market funds are paying 5% rate of return right now. Just put that money away, let it earn interest, and wait for your bills to show up, and you handle them yourself. So that's why I'm saying don't do an impound account if given the choice. Anyway, but I digress. Let's move on to the next slide, Jay, unless there was any other nuance you wanted to address in this particular topic.
I mean, just kind of piggyback off of what you said. When you're going through escrow and your lender is estimating your or maybe they have it fully dialed in based on the tax rate for your city, and you know what your payment's going to be, couple months later, this loan servicer is saying, hey, we made like your impound's not set out correctly. We're going to refund you thousands of dollars. It's really important to remember, like, maybe there's something, amiss here. I should check in with my loan officer and see if they can explain this to me, because, us as loan officers, I mean, do mistakes happen in underwriting every once in a while? Yeah, that sometimes it does, but more or less, your loan is being set up, and we're estimating the property taxes correctly because we're verifying tax rates with the county and whatnot. So if something drastic is changing a couple months later, it's somewhere along the line somebody's got some misinformation, and it's really good to just verify this before, like Jason said, before you just go and spend the money. At least set it aside and find out, ask the question, so you can make sure that you're not running into any issues moving forward.
Well said, JT.
Okay, let's go to the next slide here. I know we've kind of already been talking about this, but why the convenience of an impound account isn't so convenient. We touched on premiums and tax bills fluctuating, supplemental bills not being covered by the impound account. We're going to get into borrowers prepaying thousands of dollars to establish this account, only to still have these supplemental tax bills. Jason, you were touching on mortgage servicers incorrectly, adjusting the payment because, they're doing this escrow analysis incorrectly. So these are things, but I think the big one that I'd like to get into is the idea of prepaying your taxes and insurance to establish this account, at the time of closing, because that's where, us as loan officers, our job, we're explaining, hey, you're upfronting thousands of dollars here so that there's enough money in your account, depending on the time of year that you're closing, so that your loan servicer will be able to pay these bills for you. And then they're finding out that they're not paying some of these bills for you. And this is where all the confusion comes in. So I think it's good that let's go to the prepaid tax example, Jay, and let's take a look at that. And we're in California here. Prices are high. So we're going to see that it's not cheap to establish these impound accounts. And considering that these are requirements for low down payment and minimum down payment government loans, we can see where this can become a real problem for homeowners, within their first year.
Yeah, real quick to interject one thing on that, Jay. So here's yet another reason I just don't encourage people to do impound accounts, especially if it's a first-time home purchase. The reality is, if you choose, again, I understand, like we've said before, not to beat a dead horse, but I understand sometimes you don't have the choice. But if you have the choice, because you're putting more than 10% down on a conventional loan, you have to set up a reserve account up front. So just to simplify, just realize when you're buying a home and setting up an impound account, expect to bring more cash to the table than you would normally need if you weren't doing an impound account. So just wanted to make that statement as we head into this slide and examples, so they understand the consequence of saying yes to an impound account, if you have the choice, is you have to bring more cash to close to the closing table up front when you're buying your first home. Okay, I said it.
Yeah, thanks, Jay. And as you and I both know, we know that these impound accounts are not closing costs because they're prepaid items, but in the mind of a borrower, they view it the same, right? Because it's money that they're bringing to the table to close. It's not part of their down payment. And depending on the time of year, as you'll see on this slide, having an impound account versus not could essentially double those, for lack of a better term, closing costs, right?
Yeah, it can have a huge impact. So let's talk about the example. That's a great point.
Yeah, so I'm using the same $1 million purchase price. What's relevant? It's actually quickly becoming irrelevant, but for the time being, you can still buy, a decent number of homes for $1 million in Orange County. But, we use our 1.25% property tax rate. That's going to give you a $12,500 bill again. I used September as a closing date. Generally speaking, September, towards the end of September is when the county is sending out tax bills. So potentially you're closing on your new home and the tax bill may already be in the mail, but it's not required to be paid yet. So you're going to have the most number of months paid up front to establish this impound account, since no tax payments are being made through escrow, and the current homeowner probably hasn't paid it either. So if we're using a September closing, we're looking at 9 months paid up front. So, if we take the $12,500 bill, divide it by 12 months, and then collect 9 months of that, it's $9,375, or 75% of that entire tax bill that you're required to upfront at closing, with the rest of your closing costs, with your down payment, etc. It's quite a bit, and it's quite a bit. And at $9,000, a homeowner is going to be thinking that their tax bill is being taken care of, when in reality, a lot of that money that you just upfronted is essentially going to get refunded to you unnecessarily, right, Jay?
Mm-hmm. Yeah, exactly. And that goes back to what we were talking about in the previous slide, because sorry if this sounds a little redundant, but the servicer, once they get their hands on your file, all they know is they've just collected $9,375 for this borrower, yet they're looking at a tax bill, which of course is still the old owner's tax bill. Why servicers and why this is an issue and why this hasn't been fixed yet in their industry, I don't know, but it's a problem. And all they know is they're over collecting. They send you all the money back, and that's when the problems start.
Yeah, I mean, the issue is we've got different entities here. We've got mortgage loan servicers, we've got county assessors' offices. They both have their own way of handling, how the county handles when taxes are assessed and reassessed, and when the bills are mailed out. And then mortgage loan servicers have their whole setup of, hey, when are we going to review this loan and do an escrow analysis? And the problem is there's no real adjusting for it. They just kind of stick to what they've determined is the best way to handle it, and there's no variation, or hey, maybe we should look at this a little bit closer because of when this loan closed. It's all just kind of under one umbrella, and there's so many variables, again, depending on time of year, depending on what the previous tax bill was on the home. There's just so many different scenarios that come into play that aren't really accounted for, and that's where we run into issues.
Right. You know what the solution to this is?
No impound account.
That's literally 100% of these issues go away if you choose not to do an impound account.
Exactly.
Anyway, all right. So we've gone through some slides. We've gone through some great examples addressing supplemental bills, the amount of reserves that are required up front to set up an impound account, which that will fluctuate pretty significantly depending on time of the year. And Jason correctly chose a great time of year in September, because that's kind of at the height of the required reserves up front for an impound account. Just kind of illustrating to you, everyone listening to this, that it really makes a difference financially for people. And while the accounting might sort itself out over the course of the next 2 years after you buy a home, that doesn't mean it's not going to negatively impact you from an emotional and financial standpoint and cash flow standpoint as you're dealing with it. Because unfortunately, most of the time, people just aren't educated well enough on this. None of the appropriate expectations were made. I would say 80% of the time, with loan officers communicating with borrowers how this all works and what to expect. And that's where the pain comes in. So if everybody in the world who wants to buy a home in the United States, at least in California, could watch this 2 or 3 times, that would be amazing. And hopefully that happens for the growth of our channel, but more importantly, for the reduction of suffering that people experience dealing with the shenanigans of how the first year works and plays out with impound accounts and the county and the servicing companies and all that. Jay, is there any other slides or anything else content-wise to get through?
Yeah, I mean, we already kind of touched on whether or not it's worth it on this slide. I think that's about it, really. I would just love to hear from from current homeowners who end up watching this podcast. If you want to leave a comment or whatnot of your experience, surrounding your own impound account and what the first year looked like. I know I've had some borrowers in the past that have had some pretty painful experiences, and I only hear about it once their payment's being adjusted. I don't hear about the $5,000 or $6,000 check that was cut to them that they cashed that didn't realize they shouldn't have. But let us know your experience on this as well, and if you enjoyed the content. And I'd love to hear from it.
Yeah, that's a great point, Jay. And in wrap up, I would just encourage people, if you want help figuring out from Jason or I what's going on with your impound account, if you happen to be in the first year of ownership and things are not going well, we can at least take a look for you and quickly tell you this is why it happened and what you need to do to deal with it. Because confusion and fear comes into play because people don't know what's going on. And hopefully this podcast serves to educate and clear some of the fog and confusion around it. We appreciate you tuning in. These are all, individual circumstances. Always feel free to leave a comment in the comment section or reach out to us directly. We'll leave our contact info down below. All right. Thanks for listening. Thanks, Jay, for offering up your insight. That was invaluable. Everybody have a great day.
Thanks, Jay. Thanks for having me.
Yep.